Welcome, everybody. Thank you for joining today's webinar, Down Payment Assistance Done Right. We want to talk today about gaining efficiency with DPAs, marketing to first-time homebuyers, scoping the size of the potential audience with DPAs, and we're going to discuss a lot of the obstacles and pitfalls and challenges with regard to originating and participating in down payment assistance programs, or more broadly, homebuyer assistance programs of all types. So my name is Sean Moss, and I oversee operations and customer support at Down Payment Resource. We also have in the background answering questions, Tracy Shell, our VP of Marketing, as well as Fern White, our account manager, who deals with our lender customers and onboarding our technologies and so forth. So we want to keep this interactive. Please please submit any questions that you have as we go in the GoToWebinar control panel. You can use the questions box there or the little chat box to submit questions, comments, reactions as we go. We'd love to get your feedback. We'd love to get your opinions about some of the things that we're talking about, your perspective about some of the issues that we're going to cover. And then at the end, we'll leave time for Q&A. Now, before we dive in, that's who we are. And I'll tell you a little bit more about the company in a moment. But as we get into this discussion about down payment assistance programs, participating in them, the challenges we face, and so forth, tell us what's your role with your organization. I'm going to put a poll up on the screen here. You can click your answer on the screen and tell us: are you a loan officer, a sales manager? Are you in the corporate office and product development, or capital markets, or secondary marketing? Maybe you're in operations, and we do probably have some real estate professionals on the call as well. So let's see, already about 2/3 of you have voted. I'll give you another second here to go ahead and vote. We still have people joining the webinar. So if you're just joining, we just started out with a poll, and tell us what your role is with your organization, and then we're going to kick off the content here. All right, so about 80% of you have voted. Let's go ahead and get that off the screen. I'll close that out. All right, and so it looks like we've got some sales managers, a lot of loan officers. We've got some folks in product development or capital markets or secondary. We've got some people on the operations side, and we've got some real estate professionals. Now, let's dive in. So here's what we're going to cover: who we are at Down Payment Resource and why we even exist. We'll cover some of the most common obstacles for today's lenders when it comes to down payment assistance programs. We want to talk about the market opportunity, especially with millennials and first-time home buyers, but in particular with down payment assistance programs, and why there is such a huge opportunity of untapped potential buyers. We will talk about why most loans are declined and what we can do about that, and also how to improve your pull-through rate. And then we'll talk about some solutions to make DPA business more effective. What you're going to hear today, a lot of it comes from the field. It comes from originators of DPA programs. It comes from people in secondary marketing, capital markets. And a lot of the data we'll share with you about the market opportunity comes from the Urban Institute, Freddie Mac, NAR, people like that are constantly looking at what's the opportunity among first-time home buyers, what are the misperceptions they have, and more. So let's dive in. We at Down Payment Resource track and monitor all of the roughly 2,500 homeownership programs around the country for down payment assistance, closing cost help, tax credits, and more. And around that database of programs that we update on a monthly basis to keep current and fresh, we have built some award-winning technology that allows you to connect more buyers to the down payment help they need to buy a home. Our goal in doing this is to help you guys as lenders and real estate professionals become more efficient at DPA business, but also ambassadors for down payment assistance programs where that's appropriate. And to do so, we offer 3 unique solutions for lenders, which you'll see a little bit of later in the presentation. So what's in Down Payment Resource? When we say homebuyer programs, what does that mean? Well, about 70% of those 2,500 programs in our database are either grants or second mortgages for down payment or closing cost assistance. That is at closing help with the down payment, the closing costs, the prepaids. We'll dig into that a little bit more later. But that's the vast majority of programs around the country. Now, another 10% or so of our database are mortgage credit certificates. Those are tax credits that offer life of loan tax advantages for buyers. They're not available in every state, but in many states. And then another 10% or so of our database are affordable first mortgage loans. Those are typically from a state or local housing finance agency. And those are first mortgages with some unique benefits like low or no MI, mortgage insurance, below market interest rates, higher LTVs or CLTVs, and other advantages that are commonly coupled with their down payment assistance programs. And then we track other homebuyer assistance programs like employer DPAs, individual development accounts, which provide matched savings opportunities, and more. So that's what's out there on the whole, as sort of a big picture look into what homebuyer assistance looks like. But essentially, down payment help is everywhere. There are about 2,500 programs that come from over 1,300 different agencies, whether it's the state housing finance agency, a city, a county, or other municipality, a nonprofit. At the local level, there are community development departments, redevelopment agencies, and so forth. And then, of course, you've got employers and foundations and plenty of other entities that provide what amounts to billions in potential assistance across the mortgage, the DPA, the tax credit opportunities. But what's most important is that there are homebuyer programs to assist not just first-time homebuyers, but potentially far more than just first-time homebuyers in every state, every county, every city. And in bigger markets or metro areas, many people are surprised to find out how many programs there actually are in their market. We're going to talk a little bit about that in a few minutes. It's also important to remember that most of these programs at any given time actually have money. They have funds available for reservation. You can lock, you can reserve. They're funded and available for loan applicants and so forth. But this database is constantly changing. These programs change without notice sometimes. Income limits change at least annually. And anything may change about any program, which is why it's so important that we track and monitor all of these programs and their guidelines and criteria, links to their resources, contact information, and so forth. And on that note, we made about 90,000 updates to our program database just last year alone. So that gives you some feel for the frequency and volume of change. But we're doing that hard work at Down Payment Resource so that you can focus on marketing, originating, talking to first-time home buyers, overcoming the obstacles and misperceptions that they face or that they have. Now, we talked already a bit about who offers these programs, but just wanted to illustrate that quickly. There's a state housing finance agency in every state. There are a lot of local housing finance agencies in many markets around the country. Municipalities offer these programs, housing authorities, nonprofits, employers, and more. Now, let's put another poll on the screen real quick, and then we're going to talk specifically about some of the obstacles and challenges and pitfalls that we hear about from the field with regard to down payment assistance programs. But our question first is, how do DPAs fit into your strategy today? Are they done out of necessity, meaning they're mission critical for meeting your strategic sales goals? Are you in an LMI culture? Are they mission critical because you need to meet CRA performance goals organically? Or are DPAs simply a growth opportunity? So proactive product development, but in order to capitalize on the opportunity to serve first-time home buyers and grow your referral network? Or is this really just in response to requests from referral partners, for example? So a reactive approach to DPAs. So I'm going to put a poll up on the screen here and tell us, how do DPAs fit into your strategy today? So just as with the last poll, you can click your answer on the screen here. So go ahead and do that and tell us, do you view DPAs as mission critical, maybe for CRA performance? Do you recognize the growth opportunity for your company, for your pipeline, for your loan officers, for your marketing team by identifying ways to speak to and educate and pre-qualify first-time home buyers? Is this all done in service of referral partners? Or is this just not a strategic initiative at all? And you're just curious about what the potential might be for business with DPAs, doing more business with first-time home buyers, and so forth. So most of you have voted. I'll give you another couple seconds here to click your answer on the screen. But again, just tell us what's your strategic view of DPAs currently. All right, so that's just about everybody. So I'm going to go ahead and close out this poll. And let's look. Well, we still got votes coming in. Go ahead and click your vote on the screen here if you haven't. If you're just joining, how do DPAs fit into your business strategy? All right, we still got a lot of polls coming in. Okay. I'll tell you what, I'm going to go ahead and close this out so we can move on. So here are the results. I'm actually surprised to see this, but it's good that so many of you see DPAs as a growth opportunity. We do too, and in fact, we have a lot of data to support that possibility, and we're going to show you some of that in the next section of this webinar. But interesting also to see that a lot of you are also doing DPA business as mission critical or as born out of necessity, perhaps. And that's kind of becoming the norm. Is that in order to work with more first-time home buyers, you have to at least have the products available and be able to speak to the biggest challenge that most of the new buyers we're going to work with might face. And as we probably all know at this point, that's the down payment, right? Now, there are inventory issues in many markets, but that's a separate issue, and that's not one that we can solve with loan products. That's a byproduct of other issues. Nonetheless, that's an interesting spread. Thanks for participating in that poll. So let's move on here. So let's talk about some of the obstacles as we hear from lenders when it comes to doing DPA business. We often hear it's hard to figure out what's even available. What kinds of programs are out there? Where are they available? What are their guidelines? What does it look like today? Is it funded? And that's just figuring out what's out there when you're looking at aligning your products with your sales goals, your CRA goals, and so forth. And then there's the challenge of keeping up with the latest program guidelines as inevitably they change, right? And as we mentioned earlier, that change happens unpredictably. It happens frequently, and it can be hard to keep up with that. We totally understand because that's literally what we do. We keep up with those program guidelines to try to ease the pain for those of you maybe in secondary or capital markets of trying to keep up with that change yourself. You'll actually see a quick demo of part of how we do that and how we could help you do that later on in the webinar. But we also hear that it's difficult to do DPA business efficiently, meaning everybody in the supply chain that is impacted by a DPA knows what to do, when to do it, efficiently does it, avoids loan defects and so forth. But we also hear that it's difficult to do DPA business profitably. And we're going to speak to some of those issues and ways to get around the issue of doing these profitably. Of course, we hear that it's hard to compete sometimes if you're not working with DPAs. We feel like we're losing business unnecessarily is a common obstacle that we hear from a lot of lenders. And part of that is, maybe competitors are calling on your referral partners, builders, brokers, realtors, saying, hey, we've got this DPA or we heard about this DPA. I've got a client, but I need to know they can use this program. Well, that creates a fire drill, if you will, where if you're an originator, you got to run a new DPA through your product team or your secondary team. They've got to do the research, make a decision. There's potentially a loan app and a referral partnership or relationship on the line. So that's in part why we talk a lot about proactive product development, and we'll get to more of that too. And then, of course, we hear we can't meet our CRA goals organically. So if you are a depository bank, are you originating all your CRA eligible credits within the market where you're trying to meet those goals? Or are you having to supplement that with whole loan purchases on the back end, probably at a premium to meet your CRA goals in certain markets? We still hear a lot of that. So we want to address some of those. But we also want to talk about some of the more specific pitfalls that we hear from lenders. One thing we hear all the time is being hammered by extension fees. Now, there are ways to get around that. Right now, we want to focus on identifying what those pitfalls are. But what kinds of training, what kinds of information do people in your supply chain need to avoid those extension fees? We'll talk more about that too. Curing loan defects, like, for example, if a homebuyer education requirement existed but was not covered in the loan process, that can cause a defect that can be costly. Likewise, the income calculation methodology, if the wrong methodology was used, and a lot of those actually can relate to product changes. So if a loan app was in process, maybe even went through an agency review, like for example with a state housing finance agency, but the product that you were using changed mid loan app or after that agency review, that can trigger other requirements that maybe weren't required prior to that new product change, like Homebuyer Ed or a different income calculation methodology or a home ownership history requirement changed. Those are the kinds of things that I think catch a lot of people off guard and don't get caught after that product change and lead to defects. And then, of course, there's the pitfall of absorbing loan buybacks. And obviously, that's a big challenge. Nobody wants to go through that process. So we want to talk about some best practices we hear from those in the field, those in the trenches dealing with DPAs, like in secondary capital markets, product, and so forth, to avoid some of these pitfalls. And then, of course, there's just sort of the overarching challenge of lack of standardization that impacts your entire system. And that lack of standardization is felt in a number of ways, right? Program types are different, repayment terms are different, no DPA, no two DPAs are the same. There are so many different structures out there for down payment assistance. Borrower eligibility and property eligibility requirements can differ from program to program, or even across a set of programs from the same program provider. And then, of course, there's a myriad of nuances and variations among legal docs. There are training requirements, but there's also no standardization in terms of the training material and contents that are provided by any two DPA providers. And what we're trying to do here is not pick on DPAs. We're trying to identify the pain points that you as lenders in particular feel. And we're acknowledging that those pain points exist. We're acknowledging that the lack of standardization does in fact impact your entire system. And we realize that's even a short list on the screen here of who's impacted by this lack of standardization and by the effort to do DPAs efficiently. Yes, it impacts sales. Yes, it impacts your loan origination system. Managing your lock desk and dealing with lock desk issues across DPAs, not to mention your core products, is obviously a concern and something that has to be gotten right to avoid costs like extension fees, for example. We realize that there are disclosure issues, what triggers disclosure, what doesn't, where do you get the disclosures, and so forth. And then, of course, processing, underwriting, funding, post-closing, they've all got their own concerns when it comes to a DPA, as does secondary marketing or product or capital markets, and others we didn't list, right? Sales management has a stake in the game here, making sure that their originators have all the products they need to compete and do their business efficiently and effectively. So after all of that, what are your biggest challenges when it comes to DPAs? I'm going to put another poll on the screen. That's what we hear from the market. And maybe your answer is not up here, so which one impacts you the most. But you can click your answer on the screen. After seeing all that, is there something from this short list that sticks out to you as being the biggest challenge or the biggest obstacle that you face when dealing with down payment programs? I'll give you a couple seconds here to click your answer on the screen. All right, so we're about halfway there. Go ahead and click your answer on the screen. Now, we realize, given your role, that answer could be very different. Nonetheless, given your role within the company, originator, sales management, product, capital markets, operations, what is your biggest challenge when it comes to down payment assistance programs? All right, looks like most of you have voted. I'll give you a couple more seconds here if you want to add your vote to the mix here. All right, so let's go ahead and close this out. And we'll share the results. So here we go. This is from you guys. Pretty obvious that finding out or figuring out what's even available in your market is by far the largest or the most significant challenge that many of you face. Totally makes sense. It's at the top of the list for us because that's what we hear most commonly. Not surprised to see that at the top of the list here either. Likewise, tracking the program change. Once you figure out what's out there and start to participate in or utilize those programs, the next most obvious challenge is tracking changes to that program. And just the same, if nothing changed, it's important to know that as well, right? All right, so, and then of course, originating them profitably, organic CRA performance, and salvaging declined loans. We're actually going to talk about salvaging declined loans in a bit more detail here in a few minutes. But let's get that off the screen and move on here. So let's scope the market, and let's do that first with a question. Have you sized the market for DPAs recently? How big do you think the potential market is for down payment assistance programs? So I'm going to go ahead and put another poll on the screen here, and then we're going to show you some data that we've collected. So in terms of the market potential with first-time home buyers, how big do you think it is? Is it large and untapped, larger than we appreciate? Is it just the same as always? You know, we're still running a 40 to 50% first-time home buyer rate. That's what it's always been. So how could there be more opportunity there? Is the opportunity with first-time home buyers not worth the effort? And maybe that's from a product perspective. Maybe that's from a marketing perspective. Maybe it's from a cost perspective. I don't know, but or are you just unsure? And that's fine. We're just trying to get your position here and see what our audience thinks. And then we're going to show you some data that we've collected or that we've commissioned from various parties to uncover what we believe to be the size and the scope of opportunity with DPAs, with first-time home buyers, with millennial renters. And we'll show you that here in just a sec. Looks like most of you have voted. I'll give you a couple more seconds. You can click your answer on the screen. How big do you think the market is for first-time home buyers right now? All right, I'm going to close this out. And here we go. So a lot of you think there is a large untapped market. A lot of you think it's larger than we even appreciate or understand or have detected so far. Some of you think same as always, and that's understandable. You know, we're at what 40% of sales are first-time home buyers, whatever the number is this quarter, this month, this year. That looks like the standard for the last few years. So it makes sense, right? Well, here's what we want to do. We want to show you some information that we've gathered, starting with the Urban Institute's Barriers to Accessing Homeownership report, which we commissioned in partnership with Freddie Mac through the Urban Institute's Housing Finance Policy Center. So they did a number of things as part of this study. We want to focus in on a couple of sort of highlights from that report. And one is the drastic misperceptions that potential first-time homebuyers have, and even potential current owners have, about down payment requirements. So if you look to the far right, that's the volume of people surveyed by NAR and the Urban Institute that think they need more than 20% down to buy a home. So it's not that they think more than 20% down to avoid mortgage insurance. We know that, right? They think you actually have to have 20% down to buy a home. And we all know that's just patently false, right? FHA, 3.5% down. How many conventional options are there for 3% down, 0 down, low MI, no MI? And then if you take into account the people that think they need 10, 15%, that's the majority of both non-owners, so renters, as well as owners. It's staggering how many owners and especially prospective buyers think that they need 10, 15, 20% down just to consider home ownership. And so what do? They sideline themselves. They don't respond to your marketing. They don't go get pre-qualified. They don't talk to a realtor about finding a home. They don't talk to a loan officer about financing a home. They stay out of the pipeline. But what we want to uncover is how can we change that? So here's another look at kind of the similar issue. So in terms of familiarity with low down payment mortgages or down payment assistance programs, a staggering number of prospective buyers think that or don't know about low down payment programs like FHA, like conventional loans, some of the interesting conventional opportunities out there for 3% down, 0 down, and so forth. They just don't know about these program or these mortgage products, much less down payment assistance or closing cost assistance. So you couple that with the fact that they think they need so much down payment to begin with, and it's no wonder that so many prospective home buyers don't seriously consider getting pre-qualified with your company, working with you as a realtor, whatever the case might be, because they have these misperceptions that make no sense and that are obviously precluding them or preventing them from thinking seriously about home ownership. And if they don't think they can do it, they're not likely to reach out to you and get pre-qualified or talk about buying a house, right? Well, here's some data that came out of that Urban Institute report that illustrates a different picture, or starts to show us the scale of the opportunity here with especially millennial renters. So one of the things that the Urban Institute did was work with Freddie and some Experian credit data and identify across the 31 largest metro areas in the country how many mortgage-ready millennial renters there were that also could afford to buy a median-priced home where they live. Now, mortgage-ready meant they had a credit score that would qualify them for conventional financing and thus for DPAs. They had the income sufficient to sustain home ownership. It accounted for their debt load. It accounted for their credit history. So across 31 major metros in the US, that study found that there were about 21 million mortgage-ready renters under the age of 40. So basically 21 million millennial renters who were ready to secure a mortgage, were income and credit qualified to do so, and 88% of those, or over 18 million of those mortgage ready renters, could also afford to buy a median priced home in the market where they currently live. Now, that's pretty generous, right? Most first time home buyers are not going to buy a median priced home. They're going to buy somewhere below the median. But nonetheless, that's pretty staggering. And if we break that down a little bit, or take another approach, looking at 2017 HMDA closed loan data, we found that when we ran those loan apps through our system across all those 31 largest metros in the US, 36% or more than a third of all the people that closed on a mortgage, closed on a home and got a mortgage in 2017 were eligible for not just one, but an average of 6 down payment assistance programs in their market at that time when they closed, for an average of over $9,000 in down payment assistance. Now, obviously, that number, 9,200, that's going to vary by market. Not every DPA is the same. Some may offer 5 or 10 or $50,000 and everywhere in between, right? But across the country, on average, in 2017, across all closed loans, FHA, conventional, USDA, VA, over a third of all the people that closed on a loan were eligible for DPAs at that time, and not just one, but an average of 6 and $9,200 in assistance. That's a pretty big deal. Now, to clarify, that does not mean that 36% of financing home buyers used a DPA. That's not what this says. But it illustrates how many people, when they bought a home, were actually eligible for a program at that time. Would it have been a useful or valuable value add? Did it come up in conversation? But more importantly, given that there are so many mortgage ready millennial renters out there and so many people that bought a home anyways were eligible for these programs, what's the size of the pipeline of people that we're not reaching, not educating, and are prospective and potential home buyers that don't have this information, and they're not getting information about DPAs because we're simply not talking about it. More on talking about DPAs later. But we actually broke this down across those 31 major metros. I pulled 2 to show you guys today. We can't go through 30 different markets, but Greater Chicago. Just in Greater Chicago, as of this study late last year, there were 1.4 million mortgage-ready millennial renters under 40 in the Greater Chicago area who could also afford a median-priced home in Chicago. That's huge. That's insane. Now, there are obviously not 1.4 million properties to sell to those buyers today, right? So there's an inventory concern or an inventory issue. We can't fix that. But what we can do is recognize that there is a potential market, there's a potential pipeline of future buyers that is enormous, and they just don't have the basic education they need about down payment requirements, first mortgage options, opportunities, and DPA programs. So looking at Chicago as well, when we go back to 2017 and look at the most recent closed loan data available, again, 37%, more than a third of buyers who closed with a mortgage in Greater Chicago in 2017 were eligible for DPAs at that time. And again, not just one. If you're eligible for one, you're probably eligible for several. When you start to layer state programs, municipal programs, nonprofit programs, and so forth. So in Metro Chicago in 2017, over a third of the buyers who closed with a mortgage were eligible for an average of 8 programs and over $7,000 in down payment assistance. What does that do to LTV and thus to debt to income, PITI, MI prices, opening up conventional options? What are the compounding benefits of applying that kind of down payment assistance to a first mortgage and opening the door to more buyers? Now, another market here, and then we'll move on. Twin Cities, Minneapolis, St. Paul. In last year, when this Urban Institute study was completed, there were over 500,000 mortgage-ready renters under 40 years old who could also afford a median-priced home in the Twin Cities. That's, again, a staggering number of prospective or potential qualified buyers who probably aren't talking to you because they don't know that the opportunity is real. And then in Twin Cities, we go back to 2017 closed loan data. Again, more than a third of those who closed on a home with a mortgage were eligible for an average of 3 DPAs and over $9,000 in down payment assistance. So you look at the price point or price band that a first-time home buyer is likely to buy in. What does $9,600 in DPA do for one of those applicants? All right, now we pulled a few more markets here just to look at income and sales price limits. We often hear, and we think to some point, kind of sadly, that the income limits and purchase price limits keep these programs available only for low to moderate income buyers, for example. And absolutely, there are plenty of programs out there that are only for low to moderate income buyers. But these were income limits and sales price limits pulled for the most part from statewide programs or from very popular, very common, funded, available local big market programs in these markets. And if you look at the 6-figure income limits and the pretty healthy sales price limits, there's a lot of opportunity. And this isn't the cap, right? There may be some sort of hyper local or less common programs maybe that have higher limits. There are all kinds of outliers, right? But we wanted to pull the commonly available income limits and purchase price limits from some of these markets. If one of yours is on here, maybe you start to get a feel for, what the scope of opportunity with the actual programs might be, the flexibility they offer in terms of income or purchase price limits. And we highlighted Chicago and Minnesota because those were the 2 markets we just highlighted from the urban study. Nonetheless, a lot of flexibility, right? A lot of potential flexibility to open up first-time homebuyer business and DPAs to more buyers than perhaps we thought. And that's going to be an overarching theme today. So we put all that together. There's a big disconnect. So many buyers think that they need more down payment than they actually do. But we all know that so many prospective buyers think that the down payment is the biggest barrier to home ownership, yet none of them know about these programs for low down payment mortgages or down payment assistance. The reality is there's a huge, huge market of millennial renters that are mortgage ready today, and so many of them are also eligible to purchase a median priced home. And then, of course, you look at all the numbers about DPA eligibility for those people that have bought a home, and you got to think, what if we applied that to the untapped first-time homebuyer market we haven't really gotten to yet? And then it's also important to remember, and this is based on a Realty Track study we did a couple years ago. They're called Atom Data now, but at the time they were Realty Track, and it looked at all parcels, all residential parcels, so all single-family real estate across I think counties in the U.S. that had more than 50,000 people or so. So all the big metro areas, of course. And 87% of all homes, not just listed properties for sale at the time, but 87% of all homes were eligible for down payment assistance. So even on the property side, the properties based on price and location open the door to these programs. Now, after all that, why do we decline loans? And those are just the ones that we got in the door, right? So a lot of that data speaks to the fact there are far more people we could bring in the door. But of those that we do get in the door, that we market to, originate, process, and underwrite, Why are we declining those loans? We just added some of the most common reasons for declination here, and I'll clarify. We gather declined pipeline information from lenders upon their request, and we'll run that through our system, and we'll get out of that how many declined loans were declined for cash to close or debt to income. Those are two reasons, or those are two declination reasons that a down payment assistance program can directly address. And from that, we'll determine how many were eligible for DPA programs, how many programs, what were the benefits of those programs, how many dollars might they have gotten from a DPA if they were eligible. And it's pretty staggering. So when you think about your declined loan pipeline, for those of you who are loan officers or you're in product or capital markets or sales leadership, think about your declined loan pipeline. Maybe even look at your declined loan pipeline. We would encourage you to do so, because here's what we've found. Out of every 100 declined loans, more than half are declined for insufficient cash to close or debt to income. And again, a DPA program can directly affect or impact cash to close or debt to income. Of those that were declined for one of those reasons, over 80% were eligible for down payment assistance in that market at that price based on that loan app data in the market where they wanted to buy. The average loan amount was $236,000. They were eligible for an average of 8 programs and over $12,000 in down payment help. That comes from all the decline loan analyses we've performed, just aggregating that data to illustrate the point that even in your own declined loan pipeline, after marketing to, originating, processing, and underwriting those loan apps and sinking all of that cost into a loan app that didn't make it to the finish line and close. So with all that sunk cost, so many of those loans, more than 80% of loans declined for insufficient cash or DTI, probably could have been salvaged with the application of a down payment assistance program. So let's think about that for a moment. What's the impact of a DPA? And maybe this is obvious to everybody, but part of the goal today is to really break this down and talk about pitfalls and obstacles and our shortcomings, if we can be honest. So it obviously increases equity when you apply a down payment assistance program to a loan app. It does so by lowering the loan to value. But when you lower the loan to value, you lower the loan amount, you lower the debt to income ratio. You're opening the door to conventional mortgage options potentially. And if you can do that, you can eliminate the upfront MIP. You can reduce the monthly MI, so further lowering PITI, right? And if you're not a lender, then forgive the acronyms. But nonetheless, all of that increases the purchasing power of that buyer's income. It allows them to retain their liquid assets. Now we're getting away from like the loan app specific benefits here. But if we think bigger picture, how can we talk about these with first-time home buyers? They get to retain their liquid assets and they don't move into the home cash poor with nothing to help sustain home ownership and the costs and burdens that come with home ownership. And for you realtors, using a down payment assistance program, especially if it allows your client, the buyer, to apply some of those funds to closing costs, maybe they can create more competitive contract offers for sellers because they don't have to ask for closing costs. So they could offer the same competitive price without having to ask for help with closing costs. So a couple things to think about. Now, what's the opportunity cost with not using down payment assistance programs? Well, when we think about the declined loan pipeline, so much of the sunk cost there is not recouped by creating or accruing the revenue from having closed those declined loans. So the opportunity cost there is your origination and your other fee revenue. Then there's the SRP on the back end, or servicing revenue if you're servicing. Lost referrals from those new first-time home buyers whose social network, for the record, is largely comprised of other first-time home buyers, or likely comprised of many other first-time home buyers. But then the referral partners themselves, who may have brought more business in the door, the realtor, the broker, the home builder. If you don't have the products in place to meet their needs, are you going to continue to keep that relationship healthy? And then maybe you're looking to recruit loan officers that do a lot of first-time home buyer business, or a lot of volume, or could do a lot of volume in that regard, but they want the right products in place. If you don't have those products, are you missing out on top LO recruits? All right. So I want to talk quickly, and I'm not going to go through this line by line, but we talked about the declined loan pipeline and what we see in the declined loan pipelines when we work with lenders to identify the opportunity there. So in this sample scenario, let's assume that a lender closes 1,000 loans a month. So we're looking at sort of the enterprise perspective, right? The current average industry pull-through rate is 76%, meaning 24% of your loans get declined. Now, your pipeline may be different. If it's higher than that, let's take a look at it. If it's lower than that, that's great. But what's the opportunity we could uncover within there? So then you have the fallout, and then you've got your average costs, 8,500 per loan app. Now that varies. I actually saw last week 9,200. So maybe that's a little more current up to the month or up to the quarter, but it's somewhere between 8,000, 8,500, 9,000 per loan app to manufacture that loan app, right? That's a lot of cost, especially if it was sunk, uh, originating, processing, underwriting, and then not recouped by having closed that loan. So in this example, if we take the average eligibility rate of declined loans, we call it 66% because about half are declined for cash to close or DTI, and 80% of those are eligible for DPAs. Let's just say you convert 10% of those, you've at least recouped the cost of $1.6 million in processing, underwriting, and so forth, presuming that you broke even. And if you were doing this profitably, then you've accrued more revenue than that. And closing or salvaging just 10% of your declined pipe, we think is really low and really conservative. So the point of this is to show that the numbers play out such that a lot of the money being spent on loan apps that don't make it to the finish line to closing could actually be recouped. And a lot of those costs, a lot of those sunk costs could be recouped if we just applied a down payment assistance program. Now, I realize that's a lot of numbers, and we're not going to get into that in any more detail right now. So what do we do about all this? We've talked about a lot of issues, a lot of pitfalls, a lot of obstacles. Well, now we want to share with you some best practices that we hear from around the industry in terms of, how do we solve this? How do we get better at this? So here are some things that we hear, and we encourage you to share what you hear or how you feel. But first and foremost, doing DPA business is in fact a necessity. If you want to compete, having the right products in place is point blank a necessity. Doing DPA business right, that's a strategy. That involves sales and risk and product and secondary and operations and leadership all being bought in and all being aligned on the strategy, the goals, the product mix, the expectations among loan officers, underwriters, processors, and so forth. And it involves having processes in place and ongoing training and some of the other things that we're going to talk about here. But big picture, doing DPA business right, that's a strategy. It's not just a necessity or a reaction. Now, one of the things that we see when we talk to different kinds of lenders and banks around the country is that there's often a bottleneck. Somebody might just need a little bit of help or a little bit of automation or a little bit of training, or maybe the role doesn't exist and a role needs to be carved out for somebody that has the skill set or most of the skill set to drive proactive product development, to drive execution of a CRA strategy to help meet organic performance expectations. So sometimes the issue is just identifying who needs that help. Is it somebody in product development? Is there somebody in secondary marketing or capital markets that probably has most of the skill set and familiarity with some programs, but they just need a little bit of help dealing with figuring out what's out there, setting up a strategy to help loan officers identify and onboard new products. Maybe sales leadership needs help. Maybe they're getting demand or losing referral partners, or struggling to meet the needs of loan officers from a product perspective. And so, do they just need help getting the right products out there? Maybe risk. Maybe risk isn't bought in or strategically included in the DPA business process, but it would help if they were. And maybe somebody in risk needs to head up a strategy to make sure that underwriters are aware of the opportunities with DPAs, when they can and should be applied. As a fallback, check the approved company DPA list before declining a loan. What would happen to your decline pipeline if that were a policy? So maybe it's somebody in risk that just needs to help out or needs help from leadership in order to execute on a DPA strategy. And maybe it's your loan officers. Maybe they're fearful of or avoid DPAs because they don't feel like they have the support of any of these other divisions. So that's not to pick on anybody. It's to tell you that that's what we hear from the field. But sometimes it's just a bottleneck in one part of the company where somebody needs help or somebody could provide a little more help, and they just don't have that support, or they're not included in the strategic decisions to onboard products, get them out to the market, educate consumers, keep the ongoing training coming, and so forth. Now, another thing we hear is for those lenders that support DPAs as they do their core products, meaning ongoing training for all of the people involved, the closer, the underwriter, the processor, the originator, and so forth, that can be critical. That can be a big step forward. But essentially, all of this amounts to if DPAs are only a backup plan, as in reactive, then it's going to be hard to get it right because it's not going to have the support it needs to deal with the variation, to deal with the extra products, and so forth. So, what we hear from the field is carve out both strategic and logistic oversight. What is the strategy? What are our goals from a product mix perspective, an origination volume perspective, whether that's units or dollars? Are there certain markets where we want to, markets or branches or referral partners with whom we want to, review our product mix and get it right? But then logistics too. What's the process for a loan officer to originate a DPA attached to a mortgage? What's the process and risk for making sure that you don't decline a loan unnecessarily or when it doesn't have to be? And then who has the knowledge and skills to help out in those regards? Of course, your LOs have to know what you participate in. So, as a product person, if you're onboarding down payment assistance programs, maybe you look at that sometimes and say, well, gosh, we onboarded this program for a branch and we've only seen 2 loan apps in a year. Why is that? Is it because they dealt with it for that one transaction, then forgot about it or didn't think about it again? Maybe it's because they just don't know or don't have a good way to figure out or keep up with what you participate in as a company, what is available to them. So take a look at that. Involve risk. So everybody knows when and where and why a down payment assistance program can help. In what scenarios would the application of a down payment assistance program be available? And when could it help and how could it help? And then, of course, your LOs are probably, for the most part, commission based, right? So educating them about the value of a declination being salvaged or saved by using a down payment assistance program, that's going to speak directly to their income. So it's important for them to know that, look, we're spending all this money, marketing to these people, processing and underwriting these loans only to decline them. You're not getting paid on that. But if we can apply a down payment assistance program, even if it takes an extra 2 or 3 business days, you close the loan and you accrue all the revenue and the LO gets paid, right? And then lastly, keep DPAs simple by role. What does the LO need? What does the underwriter need? What does the closer need? What does the funder need? And then just give them that info. Instead of here's a 48-page product matrix, maybe it's just a matter of saying, you know what, here's the closer guide. It's 2 pages long, something like that, right? All right, now I'm going to have to pick up the pace here. So keep loan officers originating. So we'll just, I'll sort of ask a rhetorical question. If you want to share in the chat box, feel free. But if a loan officer comes to your product division, let's say that you have one, and they have a new down payment assistance program they want to use, what is your policy? Do you then send that loan officer back out to research that DPA and provide you with information? Or does the product team take over the request? And I ask that because what is that loan officer not doing if they have to go research a DPA and document that for the product team? They are not selling, they are not originating, and that's what they should be doing, right? Now, that's not to say there's a right way or a wrong way. It's to say that best practice, as we've seen it among banks and lenders and companies that do these programs well, is to keep the LOs originating and to give the product or the secondary or whichever team is responsible for DPAs, to give them the tools and the authority to make those decisions and to access the information they need about those programs, so that loan officers are working with buyers and not nonprofits and housing finance agencies and so forth. all in an effort to position LOs to compete with the best available products while maintaining their primary role of selling, right? Onboarding the right programs. Be strategic, be proactive about participation in down payment assistance programs. So, kind of related to the last point about keeping loan officers selling, there are ways to align your team, your product team, whatever division that falls under. There are ways to align them such that they can go out and find the programs that meet the needs or the goals of the company by branch, by market, by demand, ahead of that demand. That might sound counterintuitive, but my point was, if you've got branches or markets where you want to or think you can acquire more first-time homebuyer business, shore up your referral partnerships, then be proactive about going out and finding all of the programs available in that market and figuring out what best suits your loan officers, which ones are a match with the way that you want to do business from a product perspective, and then onboard those programs ahead of the demand from a loan officer so that you can say, hey, by the way, here are the programs we offer. Please make sure you consider these as you're marketing to and talking to first-time home buyers, your referral partners that could potentially bring in more of that business. Make sure that you understand the products that are out there. But also, in terms of profitability, we hear a lot of different perspectives on doing DPAs profitably. It's important to remember your core products are on the table if you're working with municipal programs, nonprofit programs. So keep that in mind. You control the first mortgage, you control the profitability. So it doesn't have to be the case that DPAs are loss leaders or anything like that. And then, of course, uncover any programs that align with maybe some unique referral partners. Do you have access to a stream of educators, veterans, first responders, and so forth through your referral networks? And if so, make sure you're aware of and onboard the programs that fit the needs or offer unique opportunities to those client bases. Be mindful of the pitfalls. Is your lock desk centralized? Now, there are pros and cons, but that can be a pitfall. Having loan officers, working with reservations and locks when they're not quite sure what they're doing, that can present problems. I won't get too into the details there, but something to think about. What's the best approach for your company, and how can that help avoid extension fees? Now, there are other ways to avoid extension fees too. Ongoing training is probably the biggest one. Aligning your buyer or your applicants with the right program and product up front, that's going to help as well. Be mindful of homebuyer education. When is it required? If you switch programs mid-app, make sure that you account for the new product code if that changes. Any homebuyer education or homeownership history or income calculation methodologies, or if you change products mid-loan app, do the income or purchase price limit changes, and who needs to be aware of that? The processor, the underwriter, the originator, and so forth. And then, of course, leverage your core products. We touched on that earlier, but when possible, or when you're working with, let's say, a city or a county DPA, leverage your core products. And then, of course, we've said this plenty of times, but align and educate risk, funding, post-closing, and so forth. So one of the last comments we'll make here, and then we did want to do a quick demo of our DPA directory so you can see how we can help, but it's okay to talk about DPAs. Now, a lot of people don't want to, or they're not marketing specifically or strategically or aggressively to first-time home buyers or to millennials. I hope we've identified the fact that there's huge opportunity to do that, but you have to let your realtor partners know what you offer. You have to let builders know what you offer, and that if one property in their development is eligible, probably most of them or many of them are, right? Educate more prospective buyers. How are you reaching first-time home buyers? How can you get creative about reaching more of them and getting this information out to them? Understand that down payment is the number one obstacle, and from a marketing perspective, address that head on. Let buyers know that help is out there and that you offer it. Be proud to serve first-time home buyers. Talk about it. Veterans, teachers, your referrals from other first-time homebuyer clients and so forth. Be proud to talk about DPAs, especially with those who didn't know about them. And I'll show you why in just a sec. One last note here, the bond misnomer. Very few DPAs are actually bond funded. cities and counties and so forth, they get funds from HUD through the home and CDBG funds, Community Development Block Grant. TBA funding is on the rise. There are plenty of benefits to TBA funding, including potentially waiving the first-time homebuyer requirement, increased income limits, increased purchase price limits, various second mortgage or DPA options. And there are countless other funding sources and DPA opportunities out there. And essentially, no two are the same. But don't get trapped by assuming that all DPAs are bond programs and then tie yourselves to misperceptions about what bond means. It doesn't mean today what it meant 10, 20 years ago. Now, lastly, serve your referral partners. The most popular question that we get from realtors today is, how do I find a lender? They can't find a lender or don't currently have a lender or loan officer partner who will help them navigate down payment assistance for their clients. So they are quite literally looking for you, whether that's as a company or an individual loan officer, to help them with down payment assistance programs, and they have a client base to bring to you if you can offer that support. All right, now I'll leave this on the screen here for a moment. This kind of says, what this kind of sums up a lot of what we've talked about. So, this is from a product person, knows DPAs, and I want to show you our DPA directory here in a moment. But to wrap it all up, this is what we hope to do for you. This is what we hope this information, this data, perhaps our tools can do for you. So with that, I don't have a whole lot of time left, but I'm gonna do a quick demo of our DPA directory. That is a searchable index of all of our homebuyer programs around the country to help you make faster and better informed product decisions. So it's essentially, it's a hub for all the DPAs out there to help you reduce manual research time, immediately access program information, and position your sales force with all the right products. We do have a couple other tools. We have a loan officer portal that's for sales, ops, risk, to access information about your company approved DPAs and compare programs to find the best fit for your clients, decline fewer loans, and prefer or improve CRA performance if you're a bank. And then we have a lead gen tool, our consumer portal, that allows you to access consumers and market to them with information about the DPAs you participate in. Loan officers can get their individual landing page. It's mobile friendly, and more on that. Now, quickly, I'll show you our DPA directory. We said we would do a demo. So here's the directory. You can filter through our database by state. So let's say you're nationwide, right? There's 2,400, 2,500 programs on any given day in here. You can sort by state. Let's say you want to see what's in Colorado. Well, there are 112 programs in Colorado. You can sort through all of them. You could break that down to maybe Metro Denver and say, well, I really just want to see what's in Denver County. 112 programs is a lot to review. I'm really focused on our branches in Denver. There's 68 programs. You can open up any one of these and you can get all this program detail. And we're actually deploying in the next 2 weeks even more detail about these programs. So I apologize for the quick demo here. We're coming up on the end and I want to get to Q&A, but we are offering a free trial of this directory, a 14-day free trial, no obligation, for those of you in product or capital markets or secondary at a lending institution, so that you can access programs across the country. You can filter through by program type, first-time homebuyer requirement, funding status, and so forth, and get down to the details of the programs available where you want to offer them or you need to find them, and drill down into the benefits, the guidelines, flyers, requirements, income limits, coverage areas, purchase price limits, repayment terms of all these programs, so that you can make those faster, better informed, more strategic product decisions. So I'm going to hop back in PowerPoint here. Thank you for joining us today. If you have to go, then we appreciate you joining and we'll send the recording to you. But I do, whoops, I'm sorry. I do want to, want to let you know we're going to send a recording. We're also going to send you the Urban Institute Barriers to Accessing Homeownership report, from which we pulled a lot of data that we showed to you today. We'll also send you our latest down payment report, which we put out every other month, curates content, statistics, news about first-time homebuyers, DPAs, and so forth. We'll send the recording of this webinar, and we'll send you information about the DPA directory trial. If you are interested in a trial of that DPA directory, it is for qualifying capital markets or product development or secondary marketing people. We're happy to give you a trial of that directory. And then we're also running a special on pricing for that directory. We can talk about that if you want to reach out to us. But essentially, that's a really good deal compared to the list price. And then if you want to set up a demo, if you're a lender and want to see more about what we do and how we do, how we build our products for lenders, how they're intended to be used, how we can help product and capital markets and secondary in your sales force, then Joe Whitaker is our director of sales, and we can absolutely help you get set up with him to take a deeper dive into what we do with lenders, how we make it all work for you, and how we simplify this process. So thanks for joining. I'm going to shut off the recording now, and then we'll get into Q&A.